right, there we go. Game on. All right. So again, thank you everyone for coming out. It really does mean a lot. As Chirag mentioned, we've been putting together these events for the community for a long time, and it means a lot. I know some of you have come in from pretty far away. Furthest, maybe Miami?
Miami Beach.
Miami Beach. Anybody else flying? Orange County counts. Orange County counts. There we go. All right. I thought same thing. All right. So first, I'll welcome to the stage Michael Riady, who's the founder of INDOxyz brand. So everybody can see the product placement. I gotta do it. Come on. This is delicious coffee. Thank you. Please come to the stage. Next, join me in welcoming Garrett Mott. He is the founder of Hennigh Law Corporation. Garrett. As mentioned before, Jim couldn't make it, but I still have his questions, and I'm still going to be asking them to the other ones as a little curveball, but they're great questions, and I know you're well equipped. Not worried about that. Ryan Gibson, the co-founder of Spartan Investment Group. So one of the goals of this particular panel is really to get into commercial real estate, talk about some updates and what's going on in the industry. So I'll start first with you, Michael. So in investing, you have quite a history. Where in today's market are you really looking for and finding opportunities?
Hello? First of all, thank you, Adam. Well, first of all, let me introduce myself. So I'm originally from Indonesia. My family is a real estate developer in Asia. We built in Indonesia, Singapore, Hong Kong, China. We've invested in Thailand, Philippines, and the US as well from time to time. So I come from a real estate background that looks at a lot of global opportunities, or at least pan-Asia region. And we try to focus on big thematics, where's the trend, where's the big economy is going to, and so we kind of follow that big thematic trend. So we have invested, for example, in 2008, during the subprime, we came into the US, we invested in the US, we invested in commercial office, we acquired the US Bank Tower at that time, the Library Tower, which is in downtown LA, and prior to COVID, we sold it when the market went up. So that's kind of like our one-in, kind of how we see the opportunity. Today, I'm also continuously looking at opportunities across Pan-Asia, Latin America. I look at a lot of places. And what I found recently is now I'm focusing on building a surf-focused hospitality management company that focused on acquiring real estate along surf breaks across the world and built that. And there's a lot of real estate in office, shopping malls, logistics, multifamily, and so on. I feel like the next wave is going to be somewhere under the radar, and surf is something that I find that has a big opportunity.
Thank you for that, and we'll get further into that, and I do want to talk a little bit more about INDOxyz as well. But first, Garrett, maybe tell us a little bit more about your firm as well, and then what you do.
Yeah, happy to. So let me introduce myself. My name is Garrett Mott. I'm an equity partner with our firm, which is Hennigh Law. We are a boutique firm. We specialize in 8, 9, and 10-figure projects. We build everything from the ground. So it's entitlement, blue topping, all of that, project, management, contracts, and then trial. Everyone at our firm has to be a trial lawyer. I have tried many jury trials. I've tried arbitrations, and I can tell you, I think that's why I'm on this panel, my expertise and what I've seen in commercial real estate trials, what jurors are looking for, what they're not looking for, and what are the biggest risks that I see in commercial real estate over the next couple of years.
So Garrett, I'm gonna need you to start adding this to your intro. And Garrett's also an author in our second real estate book. That's many years ago. So I'm gonna need you to author at Mission Matters. Come on.
And I also authored one of the second books, but that second book was a little bit different about what we're talking about today. It was about mechanics liens and bonds, which you can ask me about anytime. But it was a great book. I loved working with Adam on it, and Shirag, Adam, and I have known each other for about 10 years now.
Yeah, and just quick story, it's kind of funny because Garrett was one of our earliest supporters in the book, the brand, everything. I don't even know if we had a website when you were. Yeah, I don't feel
think so.
I don't feel like we did. So thank you. And when I talk about community, this is what I'm talking about. Like, we're looking to build long-term community and long-term network. So thank you again for coming out.
Thank you.
All right, Ryan Gibson, co-founder of Spartan Investment Group. Please tell us a little bit more about your firm and what you do.
Yeah, thanks, Adam. I think I was on your podcast like 6 years ago, maybe 5 years ago. So
we're all family here. Come on.
It was a while ago.
Lean in. It's okay.
We focus on buying, building, operating self-storage. We're in 12 states. We're the 36th largest operator in the country, and that's what we do. We have a construction company that builds self-storage for all of our projects and also for other people. And then we syndicate the funds to buy our projects. We've raised about $300 million to date from individual investors, 50K at a time. And we've built up about a 4 million square foot portfolio across the US. Once we buy or build, we actually operate the facility, and we're sort of trying to build up a REIT quality firm where we have different presidents and employees operating at all levels of the business. We've grown to about 150 employees. And I flew down from Seattle. That's where our capital office is. And then our headquarters is in Denver, Colorado.
Fantastic. And again, thank you for coming out, Ryan. So I'll stick with you for a little longer here. Interest rates, Treasury's paying 5% around that rate. Why should people be excited about commercial real estate right now?
Yeah, it's a great question, and it's something that we talk to potential LPs about all the time. I can just park my cash at Chase and make 5%, right? And there's zero risk, and that's going to give me cash flow. So why would I want to invest in the market? And I think one thing that we look at is historical performance, right, of commercial real estate, commercial assets. Consistently doing 15 to 20% annually over the life of an investment. And when you think about, well, I'm just going to sit and have it wait, you might be missing out. And what time in the market really is a great multiplier of your money versus just a short-term, hey, I'm going to pull everything out and just park it into some kind of a treasury or high yield savings. So I think that's on the investor's mind, right? We all know that. We talk to investors and say, I'm just going to kind of sit this one out and wait. And I think that there's always a good time to buy for the right opportunity. And I think when you look at previous performance, you'll see that over the long haul, commercial real estate has been a really great, solid, low risk food group in your portfolio.
Anyone else care to comment?
Actually, I do. One of the risks I was going to talk about later on presentation, which I can jump to now, is there is in CRE perhaps the greatest risk that I'm seeing from my clients right now is there is a very low error threshold. If you are off by just a little bit on these interest rates, if you're off just a little bit on your insurance, it's not like it was 10 years ago when I was doing a lot of transactional deals. It's now the case that there is little error for getting these projects correct. So what does that mean? That means that you have to not have delays on your project. It means that you have to have your insurance in place. It means that you have to have your bonds in place. Everything's got to be exactly right. And so in those instances where I'm seeing with my clients those kind of risks, those are the greatest risks that we need to avoid. How do we do that? It's exactly what you were saying. It's identifying these asset classes, particularly I'm seeing it in self-storage. I'm not seeing it in multifamily. I know many of you are in multifamily here. Multifamily has incredibly low cap rates, right? Cap rate here in Southern California is under 3. It's lower than office. It's lower than retail. It's lower than industrial. So I'm steering clients away from multifamily. I'm steering them into asset classes that are like yours. And those are the kind of projects that we're building right now.
And by the way, just for everyone in the audience, so we're going to go through a couple rounds of questions here, but really this is to get everyone involved. So don't think I'm going to be hogging the mic. We're going to get everybody else involved. So start thinking about questions, because you'll have your opportunity as well. And for everybody on YouTube, sorry, this one's not live on my TikTok. So Jennifer, if they give one, let us know. We'll read that out as well. Ryan, I want to go a little bit further into the self-storage side of things. I know we've had, when you did come on the podcast, and just other conversations. Maybe just talk a little bit more about your model in general.
Yeah, so think of it as like 3 sizes of fish. You got your big fish, that's your public storage, your extra space, CubeSmart, Life Storage. You've got StoreQuest, which is based here in California. Those are your big fish. They're most of the market share. They're what you see when you drive down the road. And you have medium-sized fish, and that's kind of like us, right? We've got about just shy of $1 billion portfolio of self-storage, and there's a lot. We're kind of national. There's a handful of groups. You can look up the list of the top 100 operators, and you can find different operators that do that. And then you have small fish, and small fish are kind of like 5 facilities or 6 facilities or less. And what you've seen in the industry is the big fish want to eat those medium-sized fish, or the folks that have aggregated portfolios so that they can get and achieve scale. And the medium-sized fish, like us, we want to buy up the little guys, right? We want to buy up the mom and pops. We buy the facilities that were built 30, maybe 40 years ago by a mom and pop operator who built this facility, leased it up, and has just been cash flowing for the last 20 or 30 years, and they go to air that to their kids, and they don't want to, their kids are not interested, so they sell. And we come in and we see market optimization. We see that they haven't raised rents, we see they haven't maximized revenue, maybe they're still taking cash only, they don't have prop tech to automate their facility, they don't have a lot of these value add potential things, or they've got vacant land adjacent to the parcel and they haven't gone and developed that because it's just why, right? They're 70 or 80 years old, they're collecting a $20,000 to $30,000 check every month. Why would they go through the pain of standing up a website and implementing prop tech and doing all these things? It's working. Why would I change that? So we come in, we kind of turn all the screws and really find that revenue optimization. Once we aggregate that portfolio, then we become attractive to public storage or extra space who says, we don't want to go buy one mom and pop $3 million to $5 million facility in this random market. We want to buy 30. So you can look up a transaction in Ocala, Florida, for example, where this little portfolio amassed to 30 properties, and public just came in and said, all of ours, right? So we look for high growth markets. Where is the puck going? Where are people moving? Because that's what increases storage demand. And then we go aggregate our facilities in that market, optimize, and then flip it to a institutional buyer. We just closed one today to the 9th largest operator in the country, right? So
that's you said today?
Yeah, today. Come on. I got the news right before we went on stage.
We all work here.
Yeah, it's good. So that's kind of our model, and so what we've done is we've really focused on, to your credit, you were mentioning, really dialing in your projects, really having that every little thing correct and mitigating risk. It's the number one important thing. That's why we actually hired a chief legal officer and brought that in-house to mitigate risk. But we've also been vertically integrated, right? We own the construction, we own the property management, everything is really tight. And that's how you've got to be successful in this market, because you can buy a lot of self-storage facilities that just don't pencil, right? You might be looking at them in your backyard going, well, how does someone make this math work? You've really got to be dialed in. So we buy mom and pops, operate them a little bit better, and then aggregate a portfolio to a bigger buyer. That's our model.
And I'd like to say that Mission Matters was probably good luck in closing that deal today. I mean, we didn't
100%
luck at least. Come on. So shifting focus slightly. So Michael, this is a Jim Wong question, by the way, for Jim. How do you keep thinking, bigger after your first couple transactions? And I know you're a big vision guy. How do you keep thinking bigger when it comes to acquiring real estate?
Well, I agree with what you said. So I'm in the same boat, except I see the surf industry, the surf real estate. There's a lot of It's highly fragmented, a lot of small mom and pops. And what I do is also I come and acquire all of them, or we go develop them. So in this environment where we're talking about interest rates is low, you have to be very tight. I look at development opportunities where you can develop for, I mean, in some of these places we're talking about 20, 30 cap rates, and how do you aggregate a portfolio, consolidate that industry, and bring it down to a 10 cap rate portfolio, right, and make those margins. So to make it bigger, we start off in one place in my hometown in Bali, one of the world's best surf destinations, and then we kind of look at places like Mexico, Costa Rica, South Africa, Portugal, and all these places around the world where surf is so big, and no one has really built and consolidate that, and that's how I'm thinking about building a bigger portfolio.
Thank you. Garrett, you mentioned risk earlier, and let's talk maybe from to some of the individual investors that'll watch this as well, and because I know you have an interesting vantage point working with family offices, large institutional investors. Like, what kind of tips or things that you've taken from working with these big clients can some of those individual investors out there learn from, especially navigating the upcoming environment that we're in?
So I would like to get this little involved here. So raise your hand if anybody in this room who's a developer. I want to know if you have an OSIP program. Does anybody even know what that is? OSIP program. Have you ever heard of that before?
No. Let's start there.
Okay, so let's talk about that. Mike is. It says it's
closer.
Oh, maybe you just got to be a little closer. How about that? Okay, so an OSIP program. First, I'm going to talk about risk, and then we'll talk about the solution, which is one of them is OSIP, and we'll talk about some other solutions. The main risk that developers have right now in commercial real estate is, like I talked about, there's a very thin margin of error. Why is the margin of error thin? We already know a number of things. One, we know that cap rates are really low. Two, we know that lending is not where it was 3 years ago. Three, we also know that the volume, transactional volume, both the transactions themselves and the dollars, are way down. We also know that REITs and REIT funding is half what it was in 2021. What does all that mean? It means two things that probably every developer in this room has seen. The first thing is your insurance, I bet, is way more than it used to be 5 years ago. Way, way more than it used to be. In fact, on a lot of the projects that we do, these are 100, 200, 300, 1,000 unit developments. These projects often have insurance issues because they are procuring what's called a CGL policy, commercial general liability. That's what basically everybody here has. That's what all your contractors have. Those policies have extremely low limits, okay? So you're building a $100 million building, $50 million building, and those insurance programs that your contractor has, if they're not a captive like him, he has a captive. If you don't have a captive, your insurance is probably $1 million, maybe two, a classic 2-1 or a classic 4-2. I cannot tell you how many cases I have had where these cases do not settle because there's not enough money to get the project moving. There's projects that are delayed because of insurance issues. They're delayed because of licensing problems. They're delayed because the contractors are slow and they're running out of skilled labor. You've heard about that too. The second thing that you guys have probably experienced, that all of my clients have experienced, is 4 years ago when they were originally giving their pro formas to their clients, and they said, yeah, we're gonna have 4 or 5% construction loan. We're gonna get this thing done. It's gonna be 25 months and then we'll be out of there. And that's not what happened, right? What happened instead is that all these projects got delayed. They lasted 30, 40 months. And then the kicker is the construction loan's not 5% anymore, is it? It's like 10%. So your pro forma that you originally had is gone. So how do we solve these two problems? They're the problems that everybody experiences. Well, the worst solution is to wait and hire me to try your case. Very bad idea, very expensive. Don't do that. Two easier solutions. Pull from what the public sector does when they build and the private sector doesn't use it. The public sector, every single public works project, at least in California, has something called a performance bond. Raise your hand if you've ever heard of a performance bond. Good, lots of people. Private developers don't use performance bonds. Almost never. Why? Because it's a little bit extra. You got to pay, say you're doing a $100 million building, you have to pay 100 grand. for performance bonds. Nobody wants to cut into their profits. But you're going to save $100,000. Instead, you could get a performance bond. What is a performance bond? It's a huge company like Zurich or Travelers. They come in, and if your contractor is slow on the job, he abandons you, he goes bankrupt, he loses his skilled labor force, he's delaying the job, the surety comes in, a mega multi-billion-dollar company, and performs for you. They perform. That's what the performance bond does. That's why California Works projects, they might be delayed, but ultimately everybody on those jobs always gets done and they always get paid. That's what a performance bond is. So that's the first thing I would tell all of you. The second thing is when you're looking for an insurance program, if you are a smaller developer in this room, who here has 100 million or less in revenue as a developer? Developers, 100 million or less. Okay, so quite a couple. Any of those folks, you need to be using your insurance through an OSIP program. That's an owner-controlled insurance program. An owner-controlled insurance program is going to save you a ton of headache. You guys remember about the hurricane that happened, all the leaks? Imagine how many cases I've had. I've had 8-figure, 9-figure cases as a result of all of that, with water streaming down like this, like we're sitting here right now, filling up an entire building. And people only have their standard CGL policy, 2 million, 1 million. That is not going to save you. You're going to need a significantly higher liability limit, and the only way to get that is through an OSIP program. So those are the two suggestions I would give you if you're running a private company that's not a captive, like Ryan is.
Anyone else want to jump on that at all? No big deal, right? Okay. All right, Michael. So I want to talk a little bit more about, and by the way, this will be the last question before we open it up to the audience, so get those questions ready. So Michael, I want to talk a little bit more about INDOxyz, really in your vision for the company. So as a sponsor, again, thank you for bringing out the beverage, and I look forward to doing more. Maybe tell us a little bit more about the company and your vision.
So my background is I was a real estate developer for 13 years. I built shopping malls. We're the largest shopping mall landlord in Southeast Asia. When I joined the company, this is my family's company, by the way, it's a publicly listed company. We had 7 shopping malls when I came out, and when I left, 13 years later, we built 245 shopping malls, and we have 30 in the pipeline, and we launched a REIT, and we're the first, one of the first mall REITs in Southeast Asia. And I kind of got bored. I was like, you know what? I want to do something else. I love consumer brands. I love coffee. I want to make coffee exciting like Red Bull. I was like, and take a break, right? Because I saw like how I was looking at real estate was more like, hey, how do you buy low? How do you sell high? What do you get in? So I took a break from real estate and I got into consumer just to kind of like try something different. And I found out that, you know, all the surfers drink coffee. So I was like, hey, you know what? That's a good recurring business. It's the second largest commodity in the world after oil is coffee. And it's a global business. Yes, it's very competitive, but at the same time it's a recurring, it kind of like, it's the opposite of real estate. I wanted something that's kind of like, in different cycles, people will always buy your products. So I say, you know what? Coming from Indonesia, Bali, Sumatra, Java, all these are 17,000 islands of Indonesia, I said, I'm gonna build it around that. So I started playing with that. And then that was the vision of building the beverage business. So that's the product right here. And then along the way, as I got stuck in COVID, I went back to Bali during COVID. I spent 9 months surfing with the family and the boys and everyone. And I was sitting there, I was looking out on the beach on the surf break, and then one guy came up to me and said, hey, Michael, would you like to buy this property? And I was like, I looked at it, I was like, oh, how big is it? He said, well, 2.5 acres. I looked at it, it's right from the surf break, and he's like telling me like foreigners can come, people were all locked down at home. I happened to be at the right place at the right time with some liquidity. I was like, okay, how much is this? And he gave me a number. I said, wow, it's not bad for 2.5 acres. So I was like, hey, honey, should we go buy this for a retirement home? That was the idea, it was a retirement home.
Yeah.
But I had the idea like I could just sit here and surf every day for the rest of my life and just relax, you know? And along the way, I spent 9 months, and I was like, you know what? I started traveling to different parts of the island and island hopping, and I kept seeing all these amazing surf breaks with amazing real estate. And And I kept saying, well, no one is looking at all this real estate. Because if you're not a surfer, you're not going to come out to some of these amazing places, right? So I was like, yeah, everyone's going to like Singapore, Hong Kong, Tokyo, New York to look at real estate. I went out the other way. I went completely the other way. And I was like, wow. And then so I saw this industry. So I ended up buying 6 pieces of real estate. And I said, you know what? Forget about retirement. I'm going to build a surf-focused hospitality management company. I'm going to aggregate this. I'm going to package it together, start with this, and then slowly build it to the next W Hotel or Four Seasons or whatever, but in the surf. Because what I saw was that everyone's in the traditional real estate, and then you see in the US, you've got golf courses being consolidated, you've got ski resorts being consolidated. What is the next big thematic real estate space that no one really sees? And I said, you know what, I think surf might be it. And I noticed that if you look at the whole industry, the surf industry is very fragmented. A lot of mom and pops, like you were saying, in the self-storage space. And yet the land are very affordable. I mean, these are some of the most affordable places with beautiful beaches, blue water, and tons of tourists from all over the world coming out there. And so you could acquire land from the farmers, from the locals, from all of those places. And then when you're building it, your construction cost is very low because surfers love the bamboo, they love the naturals. Like I used to build like marble floors. Everything has to be AC, lighting, it was so expensive. And now you're like, hey, they don't want that. If you give marble floors to surfers, they'll run away from you. Yeah. So I was like, wow, I can actually build like something natural and really, I mean, it's still nice, right? It's not like it's cheap. It's still nice, tastefully done. But all the materials are in that local place, right? So I said, wow, construction cost is cheap. So I did the math. Then when you're operating it, you open it up, you love the outdoor space. There's no AC, right? You open up the windows, the breeze, and all that stuff. Well, there's no operating cost, right? It's the natural air, and, you know, and so on. So I said, well, construction cost is cheap, land acquisition cost is cheap, operating cost is cheap. What is the room rates? So I found out they were charging $200–300 per night, to $500 per night. You Google Uluwatu Surf Villas, #1 surf spot in Bali. This is where all the guys like WSL surfers come out there. They're paying $500–800 a night, and you stay there. It's fully occupied, and it's made of, you know, like natural materials. So I said to myself, where do you get that arbitrage? You're able to charge a 5-star room rate, yet your costs, your operating costs, your land acquisition cost is so low, right? And you make that big return and big arbitrage. So we're talking about all this in this challenging environment. I'm actually on the opposite of the spectrum. So send all this money over my way, you know, right? So that's really, so I got back into real estate after taking a couple of years break because I found this niche that I thought this is going to be amazing. So now the idea, my vision is to build the next Virgin Group. So I saw what Richard Branson did was, how do you build Virgin Airlines, Virgin Money, Virgin Hotels, everything under one brand? And I look at Red Bull, how do you market that brand? So I said, I want to build INDOxyz into something like what they did, which is put it under one brand, and the center of my universe is surf. And the around it is active lifestyle. So my market is everything on the beach. So I live in the Palisades, and I just look out the window, I said, that's my market right there. From Malibu down to Dana Point, like all those people out on the beach, that is the market. And they understand surfing, they understand active lifestyle, they understand Bali, they understand the sun, the islands, the coconuts. That's really what I'm building. So stay at my hotel, drink my coffee, watch my surf channels, and that's the ecosystem that I'm building. And I'm able to do that because and it seems like it's a little stretch, but because my family's been in real estate for 85 years, so I was able to use that infrastructure that we have, and also our beverage consumer side of it, and combine that together, which is something that I think is very unique. Yeah, so that's a little bit about Indo.
Thank you. So Chirag, where you at? Okay, my vision is Chirag sets up a Mission Matters M by M event in Bali or one of these, Chirag, there you go. All right.
I know a guy.
That's my vision. I want to go too. All right, let's open it up for some questions from the audience. I don't know if we have, I don't think we have a traveling mic, so we're just going to have to talk a little loud on this one because these are mic'd up. I don't think it's going to reach very far. Who'd like to go first?
Do you want me to?
Yes, please. Yes. I don't think we have a traveling mic on this one, sorry.
Okay, I can speak up. Jenny Gu, I'm a real estate investor in multifamily outside of California, where rate caps are a lot higher. Question, if you guys would be willing to share, I'm just curious in terms of your real estate portfolio, do you invest yourself primarily in your industry or asset class, or if you diversify into different other types of asset classes within the commercial space?
I diversify. I'm heavily invested in notes, like private lending. I do that locally and nationally. I do multifamily LP syndications as a passive investor. I've actually invested in the same industry in another self-storage operator. Learned a few things, how to not do things. I've done things like land development deals, single family, stuff like that, with other operators, mobile home parks, things like that.
I'm the same. I also, despite being a lawyer, I invest in some of my clients' projects. I particularly like to invest in self-storage. I have some of that. I also am an LP investor in a number of syndications, typically multifamily. I like core and shell from the ground. I don't usually like remodel or TI work for a number of reasons, but particularly because I understand it. I build projects myself, and I understand and can talk to my clients and learn how the project is going. And typically, on most large core and shell from the ground projects, it might take 7 to 10 years for me to get it back, but I get a much bigger kicker than if I'm just going to do a coupon clipper, some kind of standard commercial real estate or retail play. So I have all of those, but I prefer the core and shell ground up.
My family office, we invest in different asset classes, from master plan development to office, hotels, healthcare, hospitals, apartment buildings, single family homes. So we have a pretty diversified portfolio on the family office side, where I was on that shopping mall division. But personally, I only now focus on acquiring dirt and existing portfolios that fits that thematic story.
Anyone else? Come on, don't be shy. Now's your time. Really? No other questions?
I have one. Garrett, I know I'm here in Los Angeles. I'm a commercial broker. So you're saying that multifamily, the cap rate is only 3%. Housing will always be a necessity, and there's a shortage right now. Where do you see, what's the future in your vision?
Yeah, so like I mentioned, a lot of my clients are family offices. They're in multifamily. Many of them are here in California, so that's where I'm born. While the cap rate is low, you're right that we do have a supply issue. But ultimately, the problem is not really a supply issue, it's a sales issue. It's the fact that there's no transaction volume. You can go look right now, if you would like, at any of the FRED data about transaction volume and transaction dollars. We're at the lowest that we've ever been in at least a decade, if not longer. And until that transaction volume breaks free, we're not going to see any meaningful increase in cap rates, at least here in California. The other thing is at least on most multifamily projects, the most successful multifamily projects that I have seen are significantly smaller than you would typically see. We're getting much higher cap rates for clients that are in, let's say, 50 units or less than we are for a lot of the larger ones. Why is that? Because a lot of the larger ones take too long to build, and the delay costs are just out of control. I mean, I'm trying to deal with clients who they're basically underwater on the interest rates from their original construction loan that they got in 2019. That was 4%, and now they're 7 figures under on some of those projects that are too large.
This is a follow-up to Garrett on that question. What are you witnessing with respect to lenders? Having that discussion, I mean, lenders aren't going to want to take all these back. There's clearly a disconnect. There's not a lot of sales volume either. Is it going to sit fallow? Where are you seeing activity moving? Do you have any predictions?
So at least on the lender side of our clients that are in the multifamily space, that are in those larger those larger multifamilies, 50 units and up, it's extremely difficult to get lending, as you probably can imagine. I've tried. It's very difficult for clients to get that. It's also very difficult for lenders to get the collateral backing. They're asking for a lot more on those larger multifamilies. However, on hospitality, strangely enough, we represent, I can't name them, but they're a 5-star hotel brand. They're a billion-dollar company. That particular company, when we're building their hotels for them, it is much easier to get lending for those clients than it is for multifamily projects.
What about like in development? So you're halfway into your construction, it's underwater.
Yeah.
What are you seeing happening? Are you seeing any loan modifications? Are you seeing any cooperation? Are you seeing any of that compulsion increase as a result of pressure? So
I will tell you, without naming this particular client, this is a client in Pasadena who has a large family office that is in the 9 figures. That particular project that I'm thinking of is a 150 unit Class A 6-story building that has exactly the situation you're talking about, where they're underwater. They're 7 figures underwater on their lending. We attempted to go to an unnamed Asian lender to help get a workaround on one of these issues. That lender was not very helpful on the workaround. Instead, we had to go to hard money. So they had to do that. They had a bridge loan that they had for about a year to get us through some of the expenses. Eventually, the project just COO'd. It was about 4 weeks ago. So that project was ultimately, though, delayed by about 2 years. So significant delay.
You have a lot more perspective, but just from colleagues in the industry, the lenders are not flexible at all right now. You'd think they'd be willing to work with you, or reasonable given the circumstances, and they're not. They actually, on the All In podcast, they had a whole thing on commercial lending, and I think one of the guys on there had a building that was 10 million or something, and he was trying to write down the note, and they wanted like collateral on all his stocks, and I mean it's incredibly inflexible. So it's a good question. I'm kind of curious too, what other people are seeing on what's happening. Okay, the lender's inflexible, so then what happens next? It's interesting.
What happens next?
Yeah, exactly.
All right.
It sounds like one of the big issues of slowing down is the lack of contractors. Is that right? What do you think that is from? What's causing this shortage?
You're probably referencing what I said earlier, which is about that contractors and subcontractors are having difficulty getting a workforce, a skilled workforce. That's true for very large public policy reasons. I mean, there's a lot going on with that. The fact that we're pushing college, the fact that trade schools are behind, the fact that it's seen as less desirable, perhaps, than a white-collar position. There's not as many people going into contracting anymore. You will see, particularly on larger jobs, drive around, go see our client is Walsh and Shea over here, who we did the Green Line extension. When I did that project, I will tell you that the average age of the people that were working on that project were much older than me. Just because there aren't that many young bloods out there that are getting into construction. I'm sure you own your own firm. You could probably talk about this with unskilled labor and skilled labor.
Yeah, no, I mean, great perspective. And I think, COVID hit, and then like all these people like disappeared to some private island that we don't know about. We're all still working. Surfing. Right? It's your fault. Exactly. It's your fault. No, I mean, I think if you look at the numbers, like
nomads.
Yeah, exactly. I mean, I used to be an airline pilot, and our industry was extremely impacted by the advent of baby boomers retiring. Mandatory age of 65. I don't know how often you guys go to small towns for flying, but like the service is cut. There's no pilots to fly. There's no contractors to do construction. And I think a lot of it is our baby boomer generation is retired, right? It's not that nobody wants to work. It's just that there's not the backfill, right? I sit on an alumni board or a university board, and there is, constantly what we study is a lack of millennial children going, because there's not as many, right? And then so you're going to have these declining enrollments at high schools and universities. I mean, I think we have an upcoming population, not enough people to actually physically go do the work problem. And then tons of skilled labor retiring in droves. So we see a lot of that. You know, we love to get, you know, a very experienced, skilled, you know, superintendent or whatever to come on and help educate and mentor, but, you know, they're in their last couple of years of working, and then they're gone. And then we're hiring, I mean, we're hiring a lot of contractors that, quite frankly, are coming right out of college and are interns, you know, and they're put out in the field, you know. And it's, I mean, it's ripe for opportunity, but I mean, you look at the airlines, same thing. I mean, captains getting upgraded. I mean, you're not going to see as many gray hairs in the flight deck pretty soon. You're going to see a lot of young, new millennials and, you know, Gen Z. So
it sounds like, I always look at strategy and solution. It sounds like if there could be with social media a push to these younger people and a bridge, like a concierge between these older, more seasoned contractors to really train up these younger people. Something with social media that would make it more attractive for them to enter into this kind of a workforce. Because yes, it may be blue collar, but most of my friends that are contractors, they're retired young, they own their property outright, they're doing well. They may not be multi-millionaires. I mean, they could be if they manage their money well and did what you guys do as well as their contracting. And then also the concierge factor, mentoring to train the young guys and gals. I just feel like there's something there that, as I'm hearing all of you share, and I really appreciate the information and the knowledge and the experience, I think that we got to get that going. And I don't know about the policy thing. I mean, the bureaucracy in LA is on another level. I think we all can, in real estate, we all suffer from that. But is there anything specifically bureaucratically wise? I'm also a poli-sci major before a real estate broker. Is there a way, like one of those things that you would target to get the gridlock moving?
No, you go for it. At least as to policy, since we're deviating a little bit, you know, if we're going to be talking about policy, what I see when I go onto projects, I have a hard hat in my car. I go to tons of projects all the time. When I go to projects and there's no young people there, and I meet the old grizzled veteran guy, he's usually 60 years old, he doesn't have one of these, he doesn't have an electronic remarkable. The guy's got a pad of paper, he's writing down his notes, he's on a $100 million job, and that's the way he's done it since he was 15, right? That's his way. So in order for us to get around that idea, we also have to change the inner workings of construction. That's why I love that we have a prop tech thing, by the way, because construction is, just like the law, terrible at integrating technology. I mean, horrific. They're usually 20 or 30 years behind on doing stuff, right? Everybody's still using Procore. Everybody's still using all the same stuff.
Which is state of the art.
Yeah, which is state of the art. We've been using all the same stuff for 20 years. We're all using the same scheduling software. Everyone's using Primavera. Who here uses Primavera? Anybody? Yeah. It's all the same stuff. We've all been using the same stuff for 20 or 30 years. So prop tech is probably one of the solutions to get us with less people, to get us more efficient. So I'm really interested in that discussion.
All right, we have time for one more. Mark.
Thanks. Can you talk about retail a little? I get a lot of emails, like, you know, Fargo, North Dakota, a small retail center that has a KFC or a Starbucks, and they're saying that you get a 5 or 6% cap rate. What's your take on that?
I love retail. I love small strip retail. I mean, where do you guys want to live? Right? Next to a Starbucks, next to a place to go, next to a cafe, next to a yoga studio, next to a place to eat and go dine. I think that is hot. I mean, quite frankly, I think a 5 or a 6, I mean, it depends, right? Where is it? You know, what's the traffic count? What's the demographics? But I think retail is where it's at, to be honest. I mean, we're not in it. We're solely focused on storage, but we have a lot of retail in our portfolio, just serendipitously, because we buy a self-storage property, and on the front there's some retail sites. And I think it's a highly attractive asset class. I think it's way overlooked, because when you think of retail, you think like a shopping mall, completely different thing, right? Like, not many people go into malls, but retail strip malls, like small retail centers around in vibrant communities, are highly in demand, in my opinion.
I've got to say something. He's absolutely right. You'll notice that when we talked about the problem projects that I was talking about, they're usually multifamily, maybe a public works project, maybe office. I didn't say anything about retail. In fact, let me think here. At least for the last 5 years, I have not had a single trial or a single litigation on a single retail case. Not even one. So that tells you something. I can tell you though, of all the cases I have, 80% of them are multifamily. So that should tell you something too.
All right, let's give the panel a round of applause.